Hey everyone, welcome to another dividend stock investing video. As many of you know, the stock market is correcting quite a bit right now, but I am still here buying dividend stocks. In the video today, I want to cover 5 different strategies that I personally employ during times of market correction. These are 5 strategies that help me out tremendously as a long-term investor. In my last video, which I will link to in the description and pinned comment below, I kicked off a new series where I'm describing strategies that I like to use during times of volatility. This is video 2 in that series, and so get ready. It's really exciting. And in particular, if you wait all the way till the end of the video, I'm going to share a brand new position that I just added to my portfolio. This position is going to surprise so many of you. Get ready, everyone, for a really exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone, so I want to kick off the video here with strategy number 1. Strategy number 1 is how I like to frame in my mind how my investment portfolio will evolve during times of a market compression. I like to look at my investment portfolio as a spring. One of the most difficult things that we all have to cope with during times of market correction is a portfolio value that is decreasing in value over time. And so to kind of get around this, a mental hack that I like to employ is looking at my portfolio as a spring. As you can see on the screen in front of you right now, at the beginning of a market correction, that spring has really no compression in it. The spring is wide open. But what happens as the market starts correcting, even as the investor periodically adds money to different positions, that spring keeps getting compressed. The spring is being compressed because share prices are going down, but it's also being compressed even more because the portfolio, in terms of number of shares, number of positions, amount of passive income being generated, it's actually a more robust portfolio than it was before. Yet that portfolio value keeps getting smaller. What I found during these times of market volatility is when someone's just kind of starting out and the portfolio is smaller, it's easier to keep throwing more money at the portfolio to at least keep the portfolio at a steady value. Cash flow from dividends will be growing over time, but because the market is steadily declining, that portfolio value, as money is being deployed, can kind of keep up with its own size. But when a portfolio is bigger and the amount of money that's being deployed into a portfolio is smaller as a percentage of the overall portfolio, you're really going to see that spring compress over time. But what's so interesting is when the market finally bottoms and starts going back up again, it's really exciting to just see that spring kind of open up and explode in many ways into a really large portfolio. Now, worth noting, this spring concept, it really only applies to portfolio value. And there are some dividend investors that don't even track portfolio value. That's how I used to be in my early days. I do track portfolio value now, still not quite as closely as dividend streams of income. But this first analogy is really helpful for anyone that tracks portfolio value, and portfolio value is meaningful to that investor. And I'll tell you the main hack out of all of this that I like to really take to heart is, Ian, can I add enough money to my portfolio during this correction so as the spring is getting compressed, the portfolio value doesn't really go down. At least it kind of keeps pace. Now, given the size of my portfolio now, it probably is almost impossible to keep it from going down in value even by throwing new money at it. But that being said, it's a fun game to play in. So it's almost a hack or a game. I like to gamify the strategy in some ways, that I look at that spring and I also realize at some point, it might be a year from now, it might be 2 years, 3 years, 5 years, 10 years from now, eventually that spring will explode. And I also need to remember that when that spring does explode, that's probably the time to take a step back, be a little bit more cautious, not deploy quite as much money in the stock market. But while the spring is being compressed, that is an excellent time to average into high quality dividend stocks. And worth mentioning in all of this, again, I'm talking about portfolio value, but typically, with the types of companies I own, the dividend income will go up over time. Even while the spring is being compressed, that portfolio is generating more passive income because the dividends are being increased and I'm putting more money, I'm deploying more money into that compressed portfolio. So that's strategy number one. It's a mental hack of sorts. I want to go into strategy number two, how I personally like to cope with volatile times as a conservative, long-term dividend investor. So as you can see in front of you on the screen right now, the next strategy that I want to highlight is just leveraging dividend stocks. I'm a huge believer that dividend stocks are a winning solution, especially for conservative investors, because conservative investors experience less volatility with dividend stocks during bad times, and dividend stocks provide income that investors can use to either reinvest at lower prices in the market or pay bills during good times and bad times. And what you can see on the screen right now is over the last 6 months, I'm comparing the S&P 500 versus NOBL, which is a Dividend Aristocrat ETF. You can see over the last 6 months that the S&P is down 13.97%, but you can see that the Dividend Aristocrat index there is down 6.15%. And so the market is down over twice as much as the Dividend Aristocrat index. And Dividend Aristocrats are among the best dividend stocks that there are. And over the last year, it's interesting, I'm pointing this out because the S&P 500 is only down 3.64% as compared to a negative 2.62 for the Dividend Aristocrat. So what I'm trying to say here is, especially in 2022 right now, especially as our world is transforming, just because growth stocks have plummeted over the last few months, I haven't written off growth. I don't think growth is over. I don't think tech stocks are over. And I wouldn't write that off. But what I'm trying to say is, there are times in the market when the market crashes. Typically during those times, higher volatility stocks are going to be those more innovative companies that are growing a lot quicker and tend to get ahead of themselves a little bit too much. And so for a conservative investor who doesn't like to see volatility, dividend stocks, dividend aristocrats in particular, can be such a solid foundation to one's portfolio. And what excites me so much about dividend stocks is during bad times, I don't even think about, hey, I ought to sell these stocks. I can't stomach this volatility. Well, one, my overall volatility tends to be less than the market. My max drawdown tends to be less than the market. And so it just makes me easier to sleep at night, to weather the storm. I know that I don't like a ton of volatility in my portfolio, so I cater my strategy to my own preferences, but also I'm able to almost push aside the portfolio a bit and just focus on income streams, because during bad times, those dividend aristocrats, they'll typically continue to increase dividends on an annual basis, and that will give me more cash flow. And if I go back to strategy one, as long as I keep throwing money into that compressed spring, eventually it will explode. But even if it doesn't explode into a bigger portfolio value anytime soon, by throwing more money in, those dividend stocks will generate even more passive income for me that helps me weather the storm. And so not only do these stocks have less drawdown, but they also throw off that cash flow, which can be really comforting during times of volatility. And so if you don't like market volatility, if you don't like seeing max drawdown in your portfolio, you may be in the right, you probably are in the right place here, because this channel is all about dividends and cash flow. And with that, if you love dividend stocks as much as I do, please go ahead and smash the like button. It means the world to me. Those likes really help these videos reach more people on YouTube. Don't forget to subscribe as well. I'm getting back into a regular cadence here where I'm publishing videos on a more frequent basis. Again, thank you so much for being here. And if you subscribe with that notification bell, you will never miss one of my future videos. And so with that, I want to share more strategies with all of you today on the screen about dividend stock investing. Actually, before I do that though, just check it out on the screen really quick. This is a visual representation of the S&P 500 versus the Dividend Aristocrats, and you can just see some of the volatility there over the last 6 months, how the Dividend Aristocrats have weathered the storm a lot better. And so that's a helpful screenshot. The next one I want to share though, as you can see in front of you right now, is a longer term view. If you look over the last year, you can see more or less these two classes of stocks, aristocrats versus S&P, have performed at the end of the day pretty similarly, but you can see more volatility on the upside as well with the more growth-oriented index. And so you're going to see more volatility as you move away from dividend stocks towards growth stocks. But that volatility is not only on the downside, it's on the upside as well. And so if you're more of a long-term investor who has more conservative expectations of future growth and cash flow and more of, I would call, a brick-by-brick, a step-by-step strategy, and you're not necessarily looking to 10x your money overnight or hit the ball out of the park, these are the types of investors typically that gravitate towards dividend stocks, just the types of investors who want stability. These are the types of investors who don't like seeing max drawdown. These are the types of investors who have realistic expectations of the future. Those are great candidates for dividend investing, but there are other people who may be willing to take on a little bit more risk. There are other people who want to see that volatility on the upside, and they're willing on the downside to experience it as well. Those types of investors honestly may want to gravitate more towards growth stocks or a balanced approach that contains both dividend stocks and some growth stocks, non-dividend payers as well. With that, strategy number 3 on how I'm personally weathering the storm right now in 2022 is an exciting one. Check it out on the screen right now. This one is honestly a continuation of my last video. And so in my last video, I was talking about I bonds and EE bonds. And I was discussing how, boy, at a 9.62% interest rate on the I bonds, I can't pass it up. Now, these I bonds are indexed to CPIU, which is reset, reevaluated every 6 months. And so the interest rate on the I bonds will dip over time, but those first 6 months are locked in at the 9.62. I talked about that in my last video. Now, the challenge with I bonds and EE bonds is that they pay interest, but the interest is all taken out when those bonds matured and those bonds are cashed in. Now, obviously, this is a channel about dividend stock investing. This is a channel about investing for cash flow that can be used to pay the bills, whether the market is doing well, whether the market is doing bad. And so one other strategy I want to surface today are Treasury notes and Treasury bonds. Before I get to that, I want to quote Morgan Housel. He is the author of The Psychology of Money. I heard Morgan speak today in an investor presentation, a conference that I'm attending online, and it was really helpful that he kind of reiterated what I have come to believe, and that's most investors have a risk tolerance lower than they think. He also went on to say that basically it's impossible to evaluate your risk tolerance until you've been through a market correction and you've experienced it firsthand. The third thing he said that I really loved is that the appropriate amount of savings or cushion in the portfolio, it should probably always feel like it's a little bit too much. Because he was describing that, look, when you are diversifying your portfolio, when you're thinking about planning for volatility, when you're planning about the worst, most of us out there are planning for things that we can kind of fathom. We understand that something really bad could happen, a geopolitical event, or something really terrible could happen with the interest rates going up a lot more than they have already to squash inflation. And it honestly seems that's what the Fed is doing right now. And I honestly think they're doing the right thing, because I don't want to see the dollar just inflate out of control, but they're probably going to put us into a recession, and that's what it's going to take to stop inflation. It seems at this point that's probably what the Federal Reserve will do. In some ways it's scary, but in other ways it's good for those who depend on the dollar, who don't want it to inflate out of control, and also for creating stability in the economic system for corporations here in America to continue to thrive. But I liked what Morgan was saying, but what the point I was trying to get to is what he also said is investors, when they're pricing risk, they are really bad at pricing in the unknowns. And what he was saying is over the next, say, 10 or 20 years, there are going to be market shocks and there are going to be events that none of us could have ever fathomed. And that's why the amount of buffer, savings, cash should always be a little more than seems like enough, just in case. And obviously that cash can be used sometimes when the market tanks to buy value, which I'm going to get to in a minute. But anyway, what I'm doing right now as I get older, I learned a lot of things throughout this recent market correction. And one of them I learned is that I'm a little bit more risk averse than I used to be. I'm in my 40s now. And so what I'm doing is I've seen Treasury yields skyrocket. The beauty of Treasury notes and Treasury bonds is that they pay the interest on a semi-annual basis, and that interest is exempt from state income tax, so it's just taxed on a federal level here in the United States, and it's cash flow. And what I also started realizing is, hey, I'm in my 40s. 30 years from now, I'm going to be in my 70s. A lot of us in the dividend community, myself included, like to buy dividend stocks because it's a sense of permanence. It's kind of like you buy this income stream and you have it forever, and you can even pass it on to future generations. Now, I would say that 30 years is not forever, but for someone in his 40s, 30 years putting me in my 70s, that's long enough where I'm kind of like, you know what? There's some elements of bonds here, treasuries, that remind me of dividend stocks. I'm locking in a really solid yield here, and I'm locking it in, quote, unquote, forever in some cases, especially with these longer bonds. And so what I like to do when I see any asset class radically change direction, I like to take a look. And as you can see on the screen right now, I'm just showing you what's happened recently over the last year with the 10-year Treasury. And you can see over the last, this chart is the last 5 years. You can see also, obviously, the last year. But the 10-year Treasury has spiked in terms of the interest rate, now hovering up around 3%. And so that's a really interesting event. The other interesting event I want to share with all of you is what has happened with the 10-year Treasury over all time. As you can see on the screen in front of you right now, just another chart, it shows that in general, it's been down. But again, you can see the chart starting to flatten out here. And so it's really compelling to me to lock in a 3% yield guaranteed by the government for a portion of my portfolio that is kind of more like a buffer, if you will, as Morgan Housel was saying. It's kind of that portion of the portfolio that I want to safeguard in some ways from volatility. And honestly, I can still use that yield to pay bills, which is tried and true to my strategy as an income-oriented investor. And so what have I been doing? I've been in the process of stacking up some treasuries, and I've been going pretty aggressive here. I'm actually on Corner Patreon. For my Corner Patreon tier, I'm going to be sharing a lot of interesting insights, not only about my stock portfolio, because I made a lot of stock trades recently, and I'm about to upload my updated portfolio over there. I shared recently the portfolio, what it looks like before all the trades. Corner Patrons, soon I'm going to share what it looks like after the trades. And also on Corner Patreon, after I get that stock portfolio updated, I'm going to share my bond portfolio. I'm going to share how my bond portfolio compares to the stock portfolio, because it's actually a good chunk of change these days. And so over there on Patreon, for those that don't know, I'll link to it in the pinned comment. There are two tiers, the backyard tier, corner tier. Check those out. And there's a lot of great bonus content over there. And on the corner tier, I share my percentage allocation to different positions in my stock portfolio. And now I'm going to include my bond portfolio as well. But as you can see on the screen here in front of you, the treasuries that I'm buying are all of the ones listed here. I'm buying all of them. And I will average in. Look, if yields go up even more, treasury prices go down, I'll buy even more. The beauty here is I have next to zero risk of losing principal, because I'm buying these at time of issuance and I'm holding them through maturity. And so I'm going to get my principal back, and along the way I get my semi-annual interest payments. Again, immune from state tax. They are income taxed on a federal level. And you can see here, two-year note is trading at a 2.6% interest rate. 20 years trading the highest at a 3.3%. 30-year at a 3.1%. So the purpose of this is look, these are somewhat boring investments. Treasuries doesn't get more boring than that. But as I get older, I kind of take comfort in the boring stuff, especially during times of volatility. Now, am I buying these treasuries now just because, oh my goodness, the stock portfolio is too volatile? I'd say maybe a little bit, but it's more the case that not only are stocks volatile, but I see value in the treasuries because in the first time in 5 years, these things are spiking. And I actually believe that the Federal Reserve is going to get inflation under control. And I think they're going to keep raising the Fed funds rate. They're going to get it under control. And at a certain point, if the Fed funds rate is high, does that affect Treasury yields? Will Treasury yields go even higher? Will they kind of just follow yields overall going up in bonds? Maybe, but I also think that treasuries are a function of inflation. And if they get inflation under control, I could see treasury yields kind of evening out a bit, maybe not spiking so much. And because I don't know what the future holds, I'm making a deployment now in the treasuries, and then I will take a step back. I will wait and see. If treasury yields are still reasonably good 6 months from now, I'll buy even more. And so I'm going to have that bond component to the portfolio that extends well past I bonds and EE bonds, even though I love both of those as well. And so that is the third strategy. And obviously it goes without saying that treasuries mitigate volatility in a portfolio because the principal is locked in. As long as the investor holds towards maturity, as long as the U.S. government is making good on its promises, they'll repay the principal, and that interest is coming in semi-annually, which is awesome, and it can be used to pay bills. Now, I want to share strategy number 4 that I'm using to weather the storm, weather the volatility. And so as you can see on the screen right now in front of you, I want to talk about quality. I buy companies, not stocks. And I take great comfort in looking at fundamentals. And one of the stocks recently that I've been analyzing quite a bit is Apple stock. And Apple has just hit the ball out of the park, so to speak. They announced record earnings. The revenue is up like 9% year over year, record results. And not only that, they announced a huge buyback. I think it was an additional $80 billion, and they increased the dividend by 4.5%. So whereas the market is going down, whereas the economy may slow down a bit, maybe the Fed even puts us into a recession here because they have to stop inflation. Maybe all of that happens. Will quality businesses like Apple go under? Will quality businesses like Apple even change at all? Maybe a little, but I don't see the fundamentals changing too much. And with that, I want to share on the screen right now in front of you. You can just see here the press release from Apple. Check it out. You can see here they announced financial results, and they posted a record revenue that's up 9% year over year. This is a record, and the CEO, Tim Cook, was saying the quarter's results are a testament to their relentless focus on innovation. They're pleased with their business results, and the board of directors declared a cash dividend, an increase. It was actually 4.5% rounded up to 5. Oh, and there it is, $90 billion actually added to the existing share repurchase program. And so there's a lot to love with Apple right now. And so whereas the stock is volatile, and I recently bought some more Apple stock, and the stock is down from where I purchased it, whereas it's volatile, I just don't care because I buy companies, not stocks, and I'm reinvesting the dividends. And as it goes down, my dividends will reinvest at a better level. And with that, I want to share in front of you right now, as you can see on the screen, I have some more thoughts to share about Apple stock. And what's so exciting with Apple right now from a fundamental standpoint is you can see price per share 154.51. It's trading at a forward PE, still actually reasonably solid here. It has room to go down more, but in the mid-20s next year, mid to low 20s, kind of 23 range. You can see that dividend payout ratio, though, is only 15%, so there's a lot of room to increase the dividend. I love the fact that over the last 5 years, they've increased the dividend on average by 7.9% per year. But what I love the most is this stock, or this company, if you will, is trading 16% down from its 52-week high, but the results are better than ever. And I have actually on this same screenshot here some more stats. You can see the sales are up 8.6%. They rounded up to 9. But what's so exciting is you can see the products are up 6.6%, but services are up even more at 17.3%. So that services segment of the business is truly growing quickly. Now, what also is interesting is the operating income is up 9%. So the cost of goods sold is not squeezing margins. And operating margin is still a healthy 31%. And so that top line growth is carrying down the income statement, lower on the income statement. Now, net income is only up 5.8%. But what I would say is it looks like net margin dipped a little bit because of taxes. Honestly, this company does not have control over taxes, I would say, so much. And so what I'm just trying to say here is the elements that they can control, the as good as possible, that operating income, it's very strong. They're doing just exceptionally well. And I'm seeing this time and time and time again recently. My favorite dividend stocks, my favorite investments are issuing just amazing results. Now, the market is a forward-looking mechanism, and the market is pricing in a possible recession. That's why stocks are correcting. But I'm just saying, even if there's a recession around the corner, I do think stocks and companies like Apple will continue to do very well. And with all of that, you have all been really patient, and so it's time to share the new position that I added to my portfolio. As you can see on the screen in front of you right now, strategy, so that's strategy 4. Strategy 5 on how I like to deal with volatility in my own portfolio is I like to buy value. And this is interesting. On the conference I've been attending online, the Strategic Investment Conference by John Malden, this is a very interesting conference. I listened to Ann Sonders, the chief investment strategist from Charles Schwab. She was sharing how value, it's not always in the value category. And so let me explain. A lot of us think, oh, you're a value investor, you buy utilities. When I started this YouTube channel, I was talking about utilities all day long because I was buying them at like 5% yields. Utilities right now are trading at PEs in the high teens, and they're trading at yields maybe in the 3s. They're not value right now, even though they're in a value category. What Ann Sonders was trying to explain is traditional kind of just pegging a asset or a category of stocks into a bucket doesn't always work for value investing. Investors are finding value elsewhere. Personally, I'm finding value with companies like Alphabet. I actually added Alphabet to my portfolio. My patrons know that I share all my trades on Patreon for all tiers, for backyard and corner patrons. Again, I'll link to that in the pinned comment. Check that out. But what I want to do is, as you can see on the screen in front of you right now, just share some thoughts about my experience buying Alphabet stock. It's so interesting. This one doesn't pay cash flow, but as a value investor, I cannot ignore it. And so what I want to do, though, before I even talk about Alphabet too much, is basically investors who buy value are always buying a margin of safety. There is really this concept of margin of safety that was made popular by Benjamin Graham, and he was the famous mentor of Warren Buffett. If you buy value, whether it's in a hot stock market or a bad stock market, and look, I believe that Alphabet is a value here, you'll see that in a minute, there's this concept that you're getting somewhat of a margin of safety. That margin of safety allows an investor to sleep well at night because you know you bought value. Where it's hard to sleep at night is you buy something really expensive and then it starts tanking and there's not really a lot of fundamental value to it. That's how investors can get very anxious. That's how investors can get worried. That's how investors can just feel like, oh my goodness, is my money evaporating and it's never going to come back. The most important thing as an investor is to pick a strategy that the investor can stick with for the long term, for long periods of time. I've been in dividend stocks for well over 20 years, and I'm going to be in them forever because it's the strategy that works for me. And now I'm complementing my dividends just a little bit with Treasury bonds, and maybe I'll be adding some corporate bonds as well. But I'm an income-oriented investor. I'm also a value-oriented investor. I like to buy stocks that I believe are trading at least at fair valuations because I know if I bought a stock at a somewhat fair valuation, even if it tanks, I know sooner or later the market will correct back up, it will revert to the mean, and that stock will extract its value again. Where I get awfully scared as an investor is speculating on stocks that don't have the value to back them up. Now, I've done this from time to time. Even in recent years, I have a small portion of my portfolio that is carved out for speculation. And I've noticed some of those speculative stocks that I do own have tanked. and they don't have the value always to back them up. Now, some of them do, but not all of them do. And so again, the strategy of how I cope with volatility is if I know I'm buying a reasonable value and I'm buying a company for the long term, even if the market punishes that stock, I know sooner or later it's going to come back. And if I don't need the money now and I never invest money I need now, I can just rest assured at night that I can wait around for it to come back. And so as you can see on the screen right now, look at this. This is a work of art in some ways. This is actually the balance sheet from Alphabet. I don't need to go through everything here, but I just want to say they've got $359 billion in assets and only $100 billion in liabilities. And if you look actually at long-term debt coming in at $14.8 billion, that's kind of all I need to point out about Alphabet right now is this company is built to weather any storm. There are few balance sheets that look like this. This company is earning so much cash. Now, as you can also see on the screen right now, I did a little analysis. I put a little analysis together, nothing fancy, but I just want to share right now it's trading at $2,287 per share. The reason I like the GOOGL shares is those shares have voting rights. I like to vote. I like to vote my proxies. Now, you can see that the year-over-year EPS growth, the estimates at least, 2023 versus 2022, this company is growing earnings at 19% year-over-year. At least that's what the analysts think. If they hold true to analysts' expectations, which I think they will more or less, this company is trading at a 20 PE now and a 17 PE next year. A company trading at a 17 PE that's growing, say, 19% year-over-year, even 10% year-over-year, is a screaming value, especially with the balance sheet the way they have. Now, this stock is 25% off of its 52-week high. And so I see something like that, and yes, Alphabet probably isn't going to ever provide me any cash flow. Now, I did run a poll on my Twitter. I'll actually link in the pinned comment below. Check me out on Twitter. I have a lot of great content over there. I ran a poll on Twitter, and plus or minus 70% of people that responded to the poll thought that Alphabet may one day pay a dividend. Maybe sometime 10, 20 years from now, they'll pay a dividend one day. But my portfolio is more of a Ann Sonders style story than just a strict, oh, I'm only going to buy value category these days. I like to buy assets that I believe are trading at values, but I also like to buy world-class assets. I like to diversify per Morgan Housel because we don't know what kind of catastrophe is around the corner. This is 2022, everyone. There could be anything happening, and so I want to be more cautious than ever before, and that's why I am diversified across dividend stocks, across treasuries, across savings bonds, across cash, across real estate, across some tech stocks, not many, but Alphabet and Apple are two that I do own. But I like to have an overlying theme that when I do buy these assets, generally I'm trying to buy value. And it's not always right. I'm not always timing it perfectly. I'm not always getting it perfectly. My analysis isn't always 100%. But if at least I try, that is a strategy that helps me weather any storm. And that's why I can sleep well at night and I can weather these types of storms and feel confident that this strategy I'm building is strong enough to make it for many, many decades out into the future. All right, everyone, if you enjoyed the video, please do smash that like button. It means the world to me. And share in the comments below, what do you think about all of this? Do you agree with these 5 strategies? Do you have a different approach? Do you have other strategies that help you with volatile times? Are you a conservative investor like me, a conservative income-oriented investor? Or are you maybe a little bit more aggressive than I am? Maybe you're in your younger years. Share all that in the comments below, and I can't wait to participate in that discussion. Also, don't forget to subscribe as well. I have more videos on the way. Before I go today, in terms of full disclosure, I am long the stocks mentioned today, Apple, AAPL, and Alphabet, GOOGL. Also, I am long Treasury bonds, all the Treasury bonds and notes mentioned. Also, I am long I bonds and EE bonds. I own those assets in my personal stock portfolio and bond portfolio. Before I go today, everyone, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market, the bond market, the crypto market, anywhere else, please consult your licensed financial advisor first. It's possible to lose money in the financial markets, which are so volatile these days. I'm just sharing my journey here on YouTube for fun and entertainment. I love you all. I appreciate all of you who have signed up over there on Patreon. The community is growing there as well. I hope you're enjoying all those updates on Patreon. And I will see you, everyone, in the next video.